Hi everyone, good evening. It's so nice to digitally see all of you here. I'm sure there's other people here that are on the YouTube stream, and it's great that all of you can spend the evening together with us. So thank you very much for the kind introduction by the MC. Just maybe a few liners about my background as well. I've been in Affin Hwang for almost 10 years already, and I sit on the regional equities team. Also on the side, I'm actually the geopolitical analyst for Affin Hwang Asset Management. Most of the time when there's a conflict or something that blows up, then normally I'm asked to also just give some analysis. So I'm actually more than happy to share my views on what's going on in Russia and Ukraine and all the volatility that's going on right now. So can we just go on to the next slide, and I'll just let you know what's going for the agenda for today. Okay, so the agenda is quite straightforward. So I'm going to just talk about the Russia and Ukraine crisis first. How did we get there? And maybe give a bit more historical context as to why the conflict actually, what were the seeds of the conflict, and why did we end up in this conflict in the first place? And then from there, we'll go on to the impact of the crisis, then the historical performance of markets during a crisis. And then I guess the question on everyone's mind is, should we buy the dip? And then some just brief comments on strategy and outlook. The presentation should take around maybe 30 minutes plus. And then I want to leave a lot of time for Q&A and please feel free to send in as many questions as possible. Okay, so let's go to the next slide. All right, so this is a little bit of history lesson. Don't mind me. It's something that is very close to my heart, and I believe that we should look at things just beyond the headlines and actually really what is the world that we live in now, and how did it compare to the world that we used to have last time. All right, so over here you can see that there's actually two maps, and the world before 1991 on the left, and then the world after 1991. So if you look at the map on the left, that was how the world was shaped like before 1991. Okay, so from 1949 to 1989, there was this block of countries called the Soviet Union. All right, so the Soviet Union is the countries that you see that in dark red, and that includes Russia, Belarus, Ukraine, the one that we hear about in the news, Estonia, Latvia, Lithuania. Okay, so all these countries in dark red used to be under one country called the Soviet Union. And some of you may have seen that flag before, that red flag with the sickle and the hammer. So that was the flag of the Soviet Union from 1949 to 1989. And then if you see further on to the left, there are countries in light pink. Okay, so these are countries like Poland, Romania, Hungary, East Germany. Okay, so these countries form the Eastern Bloc. And together, the light pink and the dark red countries actually form what we call the Warsaw Pact. Okay, so the Warsaw Pact is basically a military alliance between the Soviet Union as well as those countries in the light pink. All right, so that was the world until 1991. And in 1991, the Soviet Union actually collapsed. All right, so when we say collapse, means a lot of the countries within the Soviet Union declared independence, of which the biggest bloc from the Soviet Union remaining was Russia. All right, so you see on the map on the right, you can see Russia and the Russia flag over there. That is the Russia flag that we know of today. Okay, so that's a modern Russia flag. And Ukraine declared independence, if you see the blue and yellow line, which is, I'm sure a lot of you have seen over on social media nowadays, as well as a whole host of countries. Okay, so Poland, Latvia, Estonia, Lithuania, as well as a whole host of, you don't see them in the map here, but all the tans, Kazakhstan, Kyrgyzstan, Uzbekistan, all of these countries that were part of the Soviet Union all declared independence in 1991, right? So the Soviet Union, from a very big, large, proud country, was actually shrunk dramatically after 1991. Okay, we can go to the next slide. All right, so the world before 1991 was a very different world, all right? So that back then we had something called the Cold War, and Europe's biggest fear before 1991 was an invasion from the Soviet Union, i.e. the Soviet Union, which is the Soviet Union, the dark red countries, and the light pink countries with the Warsaw Pact. And if you look at the map over here, the Soviet Union and these allies, the Warsaw Pact, was all the way to the border of West Germany, all right? So imagine if you're a German and you are staying in West Berlin, all right? The biggest nightmare for any West Berliner is you wake up one day and there are Russian tanks outside your house, all right? So that's the biggest nightmare scenario for any European country. It's like you wake up one day, you know, the Russians are here, they've conquered, you know, your country. And back then, it was a scary place, okay? There were many talks of the Russians' potential invasion of Western Europe. You know, if you upset Stalin, you upset any Politburo leader, there's always the underlying threat of, hey, one day the Russians can invade us. And what they did was the Europeans and the Americans decided to form what we call NATO. So NATO is actually the North Atlantic Treaty Organization. And the most important member of NATO isn't in this map, all right? The most important NATO, you guessed it, is US, all right? The most important NATO member is US. And the most important protection that NATO gave to every single member of NATO was actually Article 5, all right? So Article 5 in NATO says that if you attack one member of NATO, you attack every member of NATO. Every member of NATO is obliged to fight back, all right? So let's just say one day, if it's 1970, the Soviet Union decide to, hey, I want to invade Italy. I want to expand the country. I want to expand the territory. Then basically, Soviet Union actually declares war on United States because United States of America is obliged to protect Italy, and everyone in NATO is obliged to come and protect them. And NATO, with US, has a formidable army. They have nuclear weapons, the full might and backing of the United States of America, which what made NATO very, very powerful as a counterweight to the fears of what Europeans used to have leading up to 1991. All right, so if you look at the map closely, the one that I would like to highlight is, where is Ukraine in this map? All right, so if you actually look, Ukraine is not in this map, all right? Ukraine just falls under the Soviet Union, all right? So if you can see from this map how the world was like back in this is from 1960, by the way. If you look at the map in 1960, there's no Ukraine inside, there's no Latvia, there's no Lithuania, there's no Estonia, so all these countries were actually all under the Soviet Union. And let's bear in mind that Putin was born in 1952. And up to 1991, the world that Putin lived in was this world, all right? This was the map that he grew up with. This was the map that he graduated with. This was the map that he went to work with. He went to work for the KGB, which is actually the Foreign Intelligence Service of the Soviet Union. And that was the world that he grew up in. And in 1991, at almost hitting the age of 40, his entire world actually collapsed, literally. All right, so let's just bear that in mind as we look at this conflict. All right, let's go to the next slide. All right, so interestingly, 1991, Soviet Union collapses, but instead of NATO shrinking, NATO actually expanded further, all right? So if you look at this map, just try to remember the map that you saw previously, okay? Former Warsaw Pact members actually joined NATO, all right? So if you look at it, in dark blue, Poland, Hungary, Romania, Bulgaria, Estonia, Lithuania, all of the Baltic states, they all joined NATO, all right? And this was all after 1991. Okay, all of them were like, okay, Soviet has collapsed. We are afraid that maybe down the road, the Russians will invade us. Let's all join NATO now to get Article 5 protection. So everyone joined. And one important country, which was Ukraine, saw what was happening and they were like, hey, we want to join NATO too. And we don't just want to join NATO, we want to join the EU as well. All right. And interestingly, if you look at Ukraine's GDP per capita, the Romanian GDP per capita is higher than Ukraine. Okay. And the irony is, last time, back in the heydays of the Soviet Union, the Ukrainians used to be, richer than the Romanians. They used to be had better technology, better education. But, after the collapse of the Soviet Union, Ukraine was actually left behind. And after they see like, hey, nothing spurs someone on like jealousy, right? Or like, hey, my neighbor is doing much better than me. I need to upgrade myself. So they was like, hey, we want to join NATO, we want to join EU. All right. And that was actually the bridge too far for Ukraine. Okay. And the war that we talk about right now has already started since 2014. And why 2014 was, if you recall, back in 2014, there was actually a pro-Russian government in Ukraine that was actually kicked out by what we call the Orange Revolution, where this bunch of protesters that went on and on and on, and they basically kicked out the government and they wanted a new government that could bring them into EU, bring them into NATO. And that was too much for Putin, all right? So in 2014, when the new pro-EU government came in, Putin immediately came in and annexed Crimea, okay? So if you see that the south of Ukraine, there's the little dashed line there on Crimea, that was the area that Putin annexed in 2014. So the war that we are seeing right now has already started, quote unquote, since 2014. All right, let's go on to the next slide. Okay, so this is the situation so far in the war, in the conflict that we are seeing. And I'm when I was preparing the slides every time, thinking to myself, when is the very last day I can submit my slides? And the reason why is the situation is so fluid. When I was first asked to give the talk, I think that time I thought that Kiev will already start to fall. How should I actually even show this map? But it turns out that the Ukrainians are still holding out. But just a few things to highlight from this map. Number one is where is Kiev? Kiev is the capital of Ukraine. So you can see Kiev is slightly at the upper top part of Ukraine, where there's a little aeroplane sign where the main airport is. So that's Kiev. So Kiev is the capital. And I just want you to just notice the bottom part of Ukraine, the southern part of Ukraine, which is to the sea. And there's this little black dot called Odessa, which is actually a very major port for Ukraine. And the reason why all of this matters is 90% of Ukraine wheat exports actually go through all these major ports at the south, right? So if you look at Odessa, Kherson, Ukrainian wheat exports actually go through here. And right now, it's a conflict zone, and the ports are not operating, and the Black Sea is actually not open to international traffic. And this will have important ramifications, which I'll touch on later. But just keep this image in the back of your head, where Ukraine at the bottom, there's actually access to the Black Sea, which is actually the only main terminal where they can export most of their things. All right. And you can see from this map, the light red areas, this is where the Russians have invaded Ukraine from. Basically, in summary, they're invading from every angle, right? So from the top, from Belarus, they're attacking Kiev. From the eastern side, Luhansk, Donetsk, which is actually already been occupied by pro-Russian forces back since 2014. They're attacking from the angle, and they're also attacking from Crimea, which they annexed in 2014. All right, so let's go on to the next slide. Okay, so a few observations from the conflict so far. I will actually put it slower, stronger, sharper, right? So these are the observations so far. And the first point that I would like to highlight is that the Russian invasion is much slower than expected. So I believe on Friday, when the news first broke that Putin has started to attack Ukraine, and then there was like pictures of cruise missiles and bombs landing, and there was all kinds of conflicting data. This airport, so and so airport was seized. The Russians are attacking from every side. It's like they're everywhere. So initially, us fund managers, we thought that, this is going to be very fast. Over the weekend, maybe next week, Kiev will fall already. And then if you look at, on social media or everywhere you see, there'll be like all this, like, Russia army, 1 point how many million soldiers. That, Ukraine army, how many 100,000? Russian defense budget, how many billion? Then Ukraine defense budget, it's like maybe much smaller. Not maybe, it is much smaller. So on paper, on every count, the Ukrainians should have been a walkover. It should, it should have been very fast, okay? And the Russian army had a very, very strong image, right? They were fighting in Syria. They modernized their air force. They were doing very aggressive cyber hacks, shutting down colonial pipeline in US. So the Russian war machine that we thought was very powerful turned out not to be as powerful as we thought. All right. So interesting observations is number one, the Russians are using not professionals but conscripts. And why this is important is professional soldiers are professional, right? This is their full-time job. They're ready to go to war. But conscripts are like national service. Your normal guy. Hey, let's go for military exercise in the border, and then next week I'm going for war. I didn't even realize it. So a lot of conscripts are being used. The Russian Air Force has not been able to achieve air dominance. When we say air dominance, is the Russian Air Force cannot control the skies. If you remember when US invaded Iraq, the first thing they do is knock out the Iraqi Air Force, knock out all Iraqi air defenses. We control the skies so that the US ground troops can go in. And because the Russians have not been able to control the skies, things have been so much slower. Okay, if the Russian convoys are like, taking their time to go forward because they know that if they rush ahead, they'll be knocked out by the Ukrainian Air Force. So the invasion on the Russian side is a lot slower than expected. Point number one. Point number two, Ukraine's resistance is much stronger than expected. And this is also important. Okay, so when Putin invaded Ukraine, he was assuming that the Ukrainians will not resist or they won't fight much. I recall even back prior to the invasion, when you were reading the news, you'll be like, the Ukrainians like, hey guys, to the West, chill out, we're not going to get invaded, we're used to this, Russia is scary, but they're not going to invade us. Then there'll be pictures of youth in Kiev going cafe hopping, all right? So everyone thought the Ukrainians will crumble. Oh, we have Zelensky, he's a comedian, right? So people thought that he wouldn't fight, but 180 degrees, it's completely opposite. The Ukrainians are fighting a lot harder, they're resisting, they're highly motivated, surprisingly. And all of this is also fueled by weapons that are given by the West, by NATO, and even neighboring countries, even such as Finland. And the weapons that they are giving Ukrainians are pretty potent weapons. We're talking about anti-tank, anti-aircraft missiles, all right? So, someone can just pack it on their shoulder and shoot down the Russian aircraft. People can hide in the forest, appear, take down the Russian tank, right? And these things are what we call asymmetrical warfare, right? So yes, you may have the biggest tank formation in the world coming, but if I got a whole group of guys who can keep firing shoulder pad missiles at you guys, you will win. The Russians will win, but the Ukrainians are putting up a much fiercer resistance than expected, all right? So that's the point number 2. Ukraine's resistance is stronger than expected. And most importantly, number 3, the West sanctions are much sharper than expected. Okay, so every day we are reading all kinds of sanctions are being placed and corporates are being pulled out, right? So BP, Shell have said that they're going to leave Russia. Then McDonald's, PayPal, Visa, MasterCard, they're getting out of Russia. Russians in Phuket who are on holiday, their credit cards have stopped working, right? And all of this is unprecedented. But the one of the most unprecedented moves that the West has taken, or US and its allies has done, is actually what they've done to the Russian banks. All right. So the Russian central bank has around 500 billion plus of FX reserves that they've held. All right. And the Russian central bank has been building this up since 2014. They know that, okay, at any time we can get sanctioned, we are going to build our FX reserves. We are going to have this big pot of money that when things go wrong, we have a big pot of money to protect ourselves, to defend the currency, and to basically smoothen the way or path or hold out as long as we want. $500 billion. That's a lot of money. And what did the West do? They basically said, your FX reserves that are held in offshore banks in Germany and Japan are all frozen. All right. And this move, I would like to emphasize, is unprecedented. All right. So the previous time that the West has done this is on Taliban, all right, on the Taliban goal, all right. So when the Taliban toppled the government in Kabul, all right. So the Taliban FX reserves was frozen now. All the gold is frozen. But that's Taliban. That's Afghanistan, one of the world's poorest country, right? You freeze the asset, it's okay. But this is Russia, the world's 11th largest economy. FX reserve has basically ceased to exist, right? The equivalent is, imagine you stored up for retirement and then you go to the bank, okay, whichever bank you want, okay, Maybank. Let's say you said, okay, I'm going to diversify. I have Maybank, CIMB, or other banks. And all the banks told you, I'm so sorry, but your name is there, your number is there, but you can't take it out. And that's actually what happened to the Russian central bank. The entire reserves got frozen. Yes, they have gold reserves, around 100 billion plus. That's sitting in Russia. But all the best in actually using that for day-to-day transactions, that's going to be really hard. But that 500 billion plus of FX reserves held in Germany, Japan, in Western countries, all frozen. And this is unprecedented, and it's much sharper. Okay, so let's recall that back prior to this invasion, what kind of sanctions were placed on Russia, right? The sanctions that we saw were, so-and-so has been sanctioned. It's like personality based, right? So Putin's good friend, okay, your sanction, your bank account in Switzerland is frozen, right? So all these are very mild things, but this is unprecedented. So again, 3 surprises from this conflict: much slower than expected, much stronger Ukrainian resistance, much sharper Western sanctions. All right, so let's go on to the next slide. Okay, so what does this mean to us day to day, and also as portfolio managers, as investors? First and foremost, the biggest impact from this conflict is on commodities. All right, so if you look at commodities, the part that people, at first when the invasion began, people said, oh, okay, Russia and Ukraine is only 2% of global GDP. No sweat, no problem. But if you actually drill down further, there's actually a lot of things at risk, right? So if you look over here in this chart, this basically tells you what is Russia and Ukraine's combined exports as a percentage of global trade, all right? So the number one, biggest part of global trade is actually palladium, all right? So palladium is a key component used in electronics. And then wheat, 25%, barley, 24%, natural gas, which I'll touch on more later, corn, aluminium, crude, platinum, nickel, steel, copper, iron ore. And the thing about all these commodities is, leading up to the invasion, the world was already at most of a shortage of most things, all right? So we were coming out of COVID, a lot of underinvestment in farmland, a lot of underinvestment in oil and gas, and there were already supply chains issues leading up to it. And right now, with this conflict going on, the situation gets a little bit more complicated, all right? And I would like to highlight again wheat, barley, corn. So basically what we're talking about is the agricultural complex, of which most of the exports from Ukraine come through the south of Ukraine, i.e. go through the Black Sea. But right now, the ports are not working. The Black Sea is closed off, and one of the main Ukrainian ports, the port of Odessa, is likely to be going to come under attack by Russian forces soon. All right. So as far as all this is concerned, the exports are not coming out. All right. So that's part one. Part two, if you look at it, the wheat planting season starts in, I think, sometime in March, where the farmers actually need to put fertilizer, March and April. If they miss this fertilizing period, the crop yield will actually be a lot weaker. And the thing is, right now, with this kind of conflict, if you're a Ukrainian farmer, very unlikely you'll be plowing the field, very unlikely that you will be going to, to be planting your crop. You'll either be fighting or not be in your field, right? There could be bombs flying, it's not safe anymore. So this is something that will be affecting global supply chains and also inflation. And if you recall back then, we had things like Arab Spring. And where did Arab Springs come from? Okay, Arab Spring started from very sharp price increase in foodstuff, all right? So if you think about wheat, and the daisy chain effects to like let's say the Middle East, Northern Africa, or even your price of noodles, or roti canai, all of these things will increase in price, especially if these disruptions. Okay, so impact number one, commodities, all right? Let's go to impact number two. Next slide, yeah. Okay, impact number two, no surprises, is energy. So Russia is the second and third largest producer of oil and gas in the world. So they are a big player there. And oil, okay, oil, yes, they are big, but oil could technically have substitutes, right? You could say, okay, we embargo Russian oil, okay, lift up the sanctions on Iran, lift up the sanctions on Venezuela. There are strategic oil reserves that US can release. So oil is not too bad. Actually, the big issue is actually on gas, all right? So if you look on the left, 40% of EU's gas comes from Russia, and all of this comes via pipes, all right? So if you look on the chart on the left, Germany's around 50+% of Germany's gas actually comes from pipes all the way from Russia, all right? So if these pipes are turned off, all right, to Germany, either way, okay, if Germany says, I don't want Russian gas, or Russia says, I don't want to export to you anymore, there is no substitute for Germany, all right? And when what I say that is, in order to find substitute, you need LNG terminals, liquefied natural gas terminals, where ships carrying gas from, let's say, Australia, Qatar, can come, dock, and offload the gas. Okay, but flash news, Germany has no LNG terminals that are working at the moment. They have two that are under construction, but that's not going to be ready this year, all right? So Germany is not ready for a gas cut, all right? And certain countries, like if you look, Australia, Finland, Lithuania, 100% of their gas is coming from pipes from Russia, and there is no substitute for this, all right? And if you look at on the right, all those dark lines here, those are where the gas pipelines are coming from. And the one that I would like you to look at is there's this word called Nord Stream 1 and 2, all right? So this is actually Russian, from Russia to Germany, direct piping. And ironically, these gas pipelines were created because of the Crimean crisis. So back in 2014, because of what was going on in Ukraine, the Russians and Germans said, maybe we should have a direct gas pipeline in case something happens in Ukraine. All right, so Nord Stream 2 pipeline was ready. It was actually supposed to be certified, but the Germans, because of this conflict, said, no, we are not going to certify it. We're not going to take any gas from you directly via Nord Stream 2. All right, so one thing to look out for is actually the impact on energy, okay? If Russian gas stops flowing, the only balancing factor for gas in Europe would actually be demand destruction, okay? So we are looking at production disruptions across the field, okay? It could be chemicals, fertilizer, automobile production, all right? And these have important ramifications on global growth and GDP. All right, let's go to the next slide. All right, so ultimately, impact one, impact two, it feeds to the most important impact, which is inflation. All right, so recall that even leading up to this event, inflation was already high. Okay, so over here in this chart, you can see that this is actually US CPI, and US CPI was already high leading up to this crisis. All right, so if you look, I think the latest reading for US CPI in February was around 7+%. It's actually no joke. It's actually on the high side. And over there, there's just a few scenarios on based on oil. Okay, so if oil hits 200, CPI will be 9.1%. If oil is 150, CPI will be 7.7%. Right. So, and this is just assuming oil. Okay, we haven't assumed the effects of wheat, the effects of barley, the effects of supply chain disruption. So the ultimate impact from this conflict is inflation on our investments, on our portfolios. And we can go to the next slide. All right, and what this means is there's this very interesting chart that Morgan Stanley made was they actually mapped US CPI with recession, right? So if you can see, high inflation tends to coincide with recessions, okay? So you can see back in 1970, the US CPI actually spiked, and then there was a recession. 1974, another spike in inflation, and there was a recession. And then even in 2008 crisis, yes, it was by mortgage-backed securities, but leading up to it, inflation also spiked and there was recession. I'm not here to say that inflation equals recession. I'm not saying that. But what I'm saying is that there tends to be a high correlation of high inflation with recession. And one of the feedback loop effects of high inflation is that high inflation tends at a certain point to be demand destructive, right? So at a certain point when prices go too high, you go like, hey, you know what? I'm going to cut back down on consumption. And it won't just be you as an individual. It'll be many people across the country, across the world says, hey, this is too much. We need to cut back down. And this has a daisy chain effect on the economy. Yeah. So it's just something that we have to be looking out for. Okay. The risk of high inflation leading to recession. All right. Okay. Next slide. All right. And to top off the challenging environment that we're facing is also central banks are looking to tighten. So if you look at the top chart, if you recall, just look at the bump up at 2020, right? So in 2020, COVID-19 hit. Okay, so COVID-19 hit, there was a big shock to the global economy. And I have to say that the central banks across the world, especially in US, did a great job, all right? So what they did was they said, we have a big situation, let's just print as much money as you can, let's expand our balance sheet. And it worked, all right? It saved the economy, it saved the stock market. And I think Jerome Powell, they expanded the balance sheet by, I think, $3 to $4 trillion. All right, that's like, I think the equivalent of maybe 3 or 4 Indonesian economies just being printed. And the balance sheet just expanded massively, all right? And like all good things have to come to an end. And we're leading up into this year. The Federal Reserve is saying that we need to have what we call quantitative tightening, all right? So before this, it was quantitative easing, where the central bank expanded balance sheet. But now we're entering a phase this year, okay, it's this year of quantitative tightening, where central banks are actually reducing their balance sheet. Okay, so when central banks reduce their balance sheet, this means there is less liquidity in the system and more headwinds for equity markets. Okay, that's number one. Okay, and number two, if you look at the US policy rate, you can see that this year is going to be it's a rate hike cycle, all right? So during COVID-19, most central banks cut rates, okay? US cut rates all the way to 0. And this year, it's actually time for them to hike back rates, okay? And when central banks are hiking rates, we call this hawkish or tightening, okay? So what's happening right now is we're having inflation, supply chain disruptions, and this is meeting central banks looking to tighten by reducing their balance sheet and also hiking rates. All right, so it's a challenging environment. Let's go to the next slide. All right, and to top it all off, the earnings season for US as well as Asia hasn't been exactly inspiring. All right, so if you look at it on the top left, S&P 500 earnings, it did beat by 4 in 4Q 2021, but it beat by a lower margin compared to the previous quarter. So instead of having blowout results, yes, you beat, but not by much. All right, so your earnings beat momentum is actually slowing down. and if you look at on the chart on the right, the S&P 500 earnings growth, you can see that yes, in 2021 there was a very sharp jump in growth because of base effect, but 2022 things are starting to normalize to maybe mid to high single digit earnings growth. The challenge about this is that this mid to high single digit earnings growth was actually forecasted before the Russian-Ukraine crisis. So what we are expecting right now is for first quarter, when companies actually start announcing their results and giving guidance, updated guidance, most likely could see guidance coming down because of a margin pressure from commodities and supply chain issues. All right, let's go to the next slide. Okay, so the question that everyone has in mind, should we buy the dip, right? We see that the markets have corrected very sharply. Should we buy the dip? Okay, so on the right, I'm not sure whether you can see this table. It's a very fascinating table. It actually compiled all the different conflicts and crises and how did the stock market do 1 month, 3 months, 6 months, and 12 months later, right? So I'll save you the scrutiny of being able to zoom in and see the numbers. The average, don't worry. I'll read out the number, right? The average return for 1 year after a crisis, average return, that means I take all the crises, I average it out. The average return after a crisis is 11.66%, all right? So this is where the quote comes in, okay? Buy at the sound of cannons, all right? So, or buy when there's blood on the street, even if the blood is yours, all right? That's, I think Rothschild said that, okay? Buy during a conflict, all right? So on average, you will make 11.6% 1 year after a crisis, on average, all right? But there's one little line over there that it's in red. I know it's very hard to read, but I'll read it out to you, okay? It's called the Yom Kippur War, okay? It's called the first oil shock, all right? So what happened in the Yom Kippur War is that the Arab countries decided to invade Israel, all right? And Israel was starting to lose the battle. And then what happened was the US started to supply Israel with weapons to turn the tide of war. This sounds familiar, right? And then the Arab countries, along with OPEC, as a form of revenge for, hey, you supplied them with all this, they decided to do what we call an oil embargo, okay? And from the oil embargo, we saw an oil shock where oil prices jumped very, very sharply. I think it was like $10 to like $40. It was a very, very sharp jump, all right? And so there was an oil shock and the world entered into a recession, all right? So in 1973, the markets corrected by 43% within 1 year, all right? So on one hand, the average says buy at the sound of cannons. The average says you will make 11.6%, but there is an event in history that says, hey, you might want to rethink it. Markets did correct by 43% during this oil shock, all right? And the parallels that we see, I wouldn't say it's 100%, but there are similarities right now in the Russian-Ukraine crisis. We are seeing higher oil prices, higher natural gas prices, higher commodity prices. Supply chains will be further disrupted and inflation will be high while central banks are hiking. If you compare to, let's say, the Vietnam War or the Gulf War, one thing to highlight is that those times were great times to buy, but the central bank, i.e. the Federal Reserve, was cutting rates during that conflict. But whereas for this time, similar to what happened in the oil shock, the central banks are hiking rates, which is going to make things a little more challenging. So should we buy the dip? I would say be very cautious, be wary of averages. If this turns out to be a Yom Kippur War, then there is further potential of downside here. Okay, let's go to the next slide. All right, so in conclusion, the outlook is challenging, all right? So I would love to give you a lot of good news. I'd love to say, hey, don't be scared, buy now. But the outlook is challenging. And these are the main three reasons, all right? The longer the conflict prolongs, the more unknown risks will emerge, right? So things that we don't know, right? So for example, last week, the Ukrainian nuclear power plant was under attack. I mean, that wasn't in anyone's expectations. Like, oh, wow, okay, they're going to attack nuclear power plants. What other risks are there down the road? We don't know, all right? This is not like forecasting earnings, right? So earnings is like, okay, what did you make last year? You made $100. Okay, next year, okay, 105. But war is different, right? War is, you are talking about many different players, many different permutations. We don't know what we don't know. And the longer it prolongs, we are exposed to more risk. Number two, inflation and supply chain problems are expected to remain for longer. Number three, the Federal Reserve is expected to continue its path of tightening this year. All right. Okay, so that's a challenging outlook, all right? And that's what I would say also summarizes why markets have been doing what's been doing, okay? But there are positive catalysts here, right? So I don't want to leave this meeting with, okay, the world is ending, everyone just buy 100% gold and, hide in the bunker for the next 100 years, okay? That's all I'm saying, all right? What I'm saying is that there are positive catalysts, and as investors, as fund managers, these are things that we are monitoring by I wouldn't say by the hour, okay, but we are monitoring very closely two things right now. Number one, peace and ceasefire settlement, all right? So, okay, unfortunately, the latest news is that the peace talks didn't go well, but this is something we need to look out for, okay? The minute Russia and Ukraine shake hands and says, okay, we will stop fighting, markets will do a U-turn, right? Oil prices will drop, wheat prices will drop, market will be a hit. Yeah, okay, fine. They may shake hands. It will take some time for things to sort out, but market is forward-looking. So market is on the lookout for a peace and ceasefire settlement, right? So market is looking out for, would Ukraine say, I will give up NATO membership, right? Would they do that, all right? Or would markets looking out for, would Kiev fall, right? So if Kiev fall and Russia managed to install a new government, that is actually a quote-unquote ceasefire settlement for the Russians as well. So just be on the lookout for a peace and ceasefire settlement. Number two, look out for central banks turning more dovish, all right? So in the latest briefing that Jerome Powell gave, he said that they are still on path to hike rates, all right? So that he's not changing course at the moment, all right? But if Jerome Powell or ECB or any other major central bank like BOJ suddenly say that, okay, things are challenging, we are A, going to cut rates, B, not going to hike rates, or C, continue quantitative easing, market will make another very, very sharp rebound, all right? So two things to look out for, peace and ceasefire settlement, central banks turning more dovish, all right? So in terms of our strategy right now for our Asia portfolios, we are actually having pretty decent cash buffers, all right? So depending on the funds, we are having around 20 to 30+% cash, and we are deciding to stay defensive at this moment. We are reluctant to buy directly into gold or oil because it's rallied quite a fair bit, but we are on the lookout for what we say, peace and ceasefire settlement, central banks turning more dovish. So as a recommendation to investors across the board, the general rule of thumb is stay diversified. When things are bad, they are not as bad as they always seem to be. And when things are good, things are always not as good as they seem to be. So be nimble, have a cash buffer, and stay defensive, and look out for inflection points, especially in this conflict. All right, so sorry, I think I've spoken quite a lot. I'm sure there'll be a lot of questions, and I'll be more than happy to take all the questions you all can throw at me. Thank you.
Thank you, Mr. Khoo, for your insightful presentation. Now we will proceed to the Q&A section. They have few questions over here. The first question is, how is the risk or reward profile of Malaysia's stock market compared to other major Asian markets?
Okay, the risk reward profile for Malaysia would be similar to the rest of Asia. And the reason why I say this is with rising oil prices, it would also affect Malaysia economically. Yes, I know that our government makes money from Petronas royalties, but in the end, I believe that when the inflation rises too much, it will also affect us. So it's something to be looking out for in inflation for Malaysia.
For the second question is, since Europe in a state of instability due to the Russian and Ukraine conflict, will the ASEAN and Far East region to be a safer bet for investment? Will ESG-based fund be the safer bet as well?
Okay. Okay, so there are two questions. The first one on ASEAN. Okay, so yes, I mentioned about Malaysia earlier, but ASEAN, yes, it is deemed to be more defensive relative to Europe, and also relative to China in a way. And the reason why we say this is because ASEAN is out of the political hot zone, right? So you're not facing a threat of your gas supplies being cut off. You're not facing the threat of invasion. So ASEAN, surprisingly, it turns out quite well on a safe haven basis. In terms of ESG investing, I would say we are actually looking at a potential shift in ESG. And the reason why I say this is two things. So ESG generally would shun away from arms as well as oil and gas. And interestingly, from this conflict, arms and oil and gas is actually the thing that people actually need the most right now. And there's actually a big tectonic shift in the way people are looking at ESG. So I would say just be on the lookout for the trends of ESG and what you're buying in, because who knows, 1 or 2 years later, your ESG fund would have defense and oil and gas inside.
Okay, for the next question will China be alternative engine of growth for the world as we come out of the COVID-19 pandemic, and with the ongoing Russian and Ukraine crisis? Is China still attractive?
Actually, yeah. So earlier on, I mentioned about the sanctions on the Russian central bank and the FX reserves being frozen. So actually, the main takeaway from that is that the RMB would stand to be one of the biggest beneficiaries. So if I am an OPEC country and I'll be like, oh, my FX reserves could actually be frozen one day, the natural thing that you would do is to actually start invoicing in RMB. Or if I'm a central bank governor and I never know one day if I offend US, my reserves will get frozen. What am I going to do? I will actually hedge my bets and put them into more RMB. So in terms of RMB currency, I think it's long-term, this is very positive for it. There's a lot of important ramifications for how global reserve currency status plays out from here. And in terms of China market, so earlier on, I mentioned that central banks are tightening, but China is actually the opposite. China is actually starting to loosen, which is actually a good place to be in when the central bank is actually starting to loosen. So yes, in conclusion, yes, it is good for China and also good for Chinese equities.
Okay. Which fund has the exposure in Russia and Ukraine?
Oh, okay. This one, very easy. None. Okay. We don't have any direct Russia and Ukraine equities exposure. Yeah.
Okay. Another question is, not all markets are equally affected by crisis. Are there any market are less impacted by that might present opportunity for investor to invest?
Okay, so earlier I mentioned China. Actually, another beneficiary is actually US, right? So US is not a net importer of energy. So they are almost, I think they are neutral / net exporter. And if US also stands to benefit because they are actually shielded from the conflict, and if the shale players start to increase their oil production, they'll be a net exporter of energy, interestingly, even during this conflict. And they are also viewed to be, you're surrounded by two big C's from any conflict, net exporter of energy, so it's also positive for US.
Okay. We also got a question for our YouTube channel. The first question is, which industry are worst hit by the Russia and Ukraine war at Asian market, and how can we handle this situation as an investor?
Okay, so the industries that would be impacted the fastest would actually be consumer goods. So if you are making food products, if you're a restaurant operator, your raw material price will spike up very quickly in the next few months, and this will be negative for you. So that's one sector to be wary of. And then the benefit, and then if the conflict prolongs, so that's why during my presentation, there's something I want to highlight is that if it prolongs, which it looks like this, then there are actually other things that would be impacted, right? So industrial production, even semiconductors could be affected, right? So I think Ukraine is a big maker of neon gas, which is in semiconductor making, so that will be also affected. So so the way to look at it is it will get worse before it gets better, right? So if this conflict goes on for years, then the global supply chain will adapt and adjust, all right? So I hope that answers the question. Yeah.
Okay. Another question for YouTube also. What is the Affin asset management step to reduce the impact or take advantage of the current volatile market?
All right. So for us, we are raising cash. So we have raised cash, right? So leading up to this conflict, we were already 15 to 20% cash. And now during this conflict, we've increased it to I think 30+% cash. So the best protection for us is cash and also having defensive stocks. But at the same time, we are looking for opportunities to buy. So valuations, I have to say, are starting to look attractive. MSCI Asia X Japan is already at, I think, 11 times PE, which is back to its 10-year average and coming below that. So I believe that there are opportunities. So eventually we'll be looking to deploy, especially looking out for any peace and ceasefire settlement or central banks turning more dovish.
Okay. Another question is for this investor. Looking at India and China stance on the Ukraine and Russia conflict, will they be beneficiary of alternative market for Russia? Will their economy do well in this crisis?
China, yes, as I mentioned earlier. So reserve, the RMB will have greater adoption. Their central bank is on the easing cycle. So China, I think, will benefit. India, not so much. And the reason why I say this is two things. Number one, India is a net importer of energy. So sharp increase in oil prices is bad for India. That will affect their current account. It will make it further into deficit. Secondly, it's actually on commodities. So India imports a lot of commodities, I think like palm oil, rapeseed oil, different types of oils. This is bad for inflation, and in the end, it'll be bad for the economy.
Okay. For another client asking, for diversification purpose, looking outside Malaysia in this current situation, which market would you recommend to invest for investors who are new investing, like US, China, or Singapore, or Asia, Japan?
Okay. I mean, I would like to say all of the above. But I mean, if you were to pick a market, like, the next step, then the next step would be, I would say, Singapore. The reason why Singapore is Singapore, the main part of the index, Singapore is a natural barbell, and I say barbell meaning on one hand you have banks. Banks you benefit from rate hike increase. So as I said earlier on, central banks are looking to hike rates. So these are good for like the major banks in Singapore, DBS, UOB, OCBC. And on the other side, you have REITs, right? So REITs are also defensive. It gives you a place to shelter consistent income. Basically, you're a landlord. So Singapore would be, I would say, quite an easy place to look to the next market for investor looking to diversify out of Malaysia first. Yeah.
Okay. Another investor asking, can you define the state defense? What is mean?
Say that again.
Stay defensive. Okay.
So sorry. Okay, yeah. So staying defensive means we are cautious, right? So that means you're holding cash. We are not taking aggressive risks. We're not looking to add on risk to the portfolios. We're actually trying to reduce beta, have buffer. So if things go wrong longer, we are ready, and we're not fully invested where we have no room to maneuver.
Okay. For our investor asking, as you mentioned, China equity are attractive at this moment, right? Due to their policy easing, would property crisis will be concerned then?
Okay, so property crisis, it is still a source of concern. I mean, in the latest national policy meeting, I think they did reiterate that houses are for staying, for living, and not for, I think, speculating or something. So in terms of property, I would be a bit cautious about buying property. I mean, property companies in China, and if you must, then pick the most solid one. Means strongest balance sheet, preferably state-owned enterprise. Don't take a highly leveraged property developer that could go under.
Okay. For another question for our YouTube is if we want to invest now, what would be a good option?
Okay.
What's the best option now?
Okay. Wow. If you want to invest now, what's the best option? Well, I would say that our Select Asia X Japan Opportunity Fund would be a good one because it already has a pretty good cash buffer there. I think 30+%. So if you buy it, then the fund manager would make the decision for you when to deploy. and the portfolio has like Hong Kong, India, and a few different countries as well. So it's also diversified. So I think that'd be a good place to park.
Okay, thank you, Mr. Khoo. Due to the time constraint, I think this will be take the last question. Another last one will be, do you believe the EV, renewable, and such are currently opportunity, or is the view on this area similar to the overall outlook of being cautious and defensive?
I would be cautious and defensive on EV. There are two reasons why. The first reason is if you look at the main component of EVs, you're looking at a lot of minerals, right? A lot of metals and minerals, nickel, copper, and a lot of this basically form the battery and when you're making an EV car. And as I mentioned just in the commodity slide, all of these metal prices have also gone up like gangbusters. So your EV cost of production has actually shot up, right? So I would be cautious on EV on that. And secondly, a lot of EV car valuations are extremely frothy. I think Tesla's valuation is like more than the top 5 or 10 automobile makers combined together. It's like Tesla market cap is higher than that, right? So it's something to be wary of. So you have valuations and cost of production that will be challenging. So I'll be quite cautious on EVs.
Okay, thank you so much, Mr. Khoo. Ladies and gentlemen, this will be end of our Q&A section. If you have further questions, feel free to send us an email, investhelp.my@fundsupermart.com. And then for replay of tonight's section will be available after this. And then all investors may proceed to our YouTube page to catch this replay. But before end of this webinar, right, I would like to share our currently our FSMOne run a promote is about the bonus unit campaign. Diversify your portfolio and amid volatility and inflation. You can enjoy 50 ringgit bonus unit when you invest a minimum 1,000 in one of the 5 unit trusts in this campaign. The participant fund which have principal Asia Pacific Dynamic Growth, MYR, Affin Asia Japan Growth Fund, MYR, RHP Big Cat China Enterprise Fund, Eastspring Investment Dynasty Equity Fund, and Manulife Global Resources Fund. This campaign is valid from 7th of March 2022 until 31st of March 2022. For more information, you all may proceed to our FSMOne website. And then once again, thank you very much, Mr. Khoo, and thank you everyone for attending tonight's section. Good night, everyone.
Thank you. Good night.